Welcome to today's deep dive. We are getting right into something pretty wild today. Every single day, massive financial institutions trade trillions of dollars in the foreign exchange market.
Yeah, trillions. It's just a massive scale.
Right, but the barrier to entry for you to sit at that exact same table as those global mega banks is,
Huh.
well, basically just uploading a picture of your driver's license.
That is the wild reality of Forex that we're looking at in our sources today. On one hand, you have this complete, unrestricted legal accessibility.
But on the other hand,
On the other hand, there's a survival rate that demands, highly specialized discipline.
okay, so let's unpack this. Our mission today is to figure out this massive gap, because if you are of legal age, you live in a supported jurisdiction, and you pass a broker's basic identity check, you get an account.
Yeah, no finance degree required, no special licensing at all.
Which is crazy. It's like passing a basic eye exam, getting your driver's permit, and immediately being handed the keys to a Formula One car on the Autobahn.
That's a perfect analogy, honestly.
Yeah. So if the gates are just wide open, how do everyday people like college students or business owners actually survive in this arena with the big institutions?
Well, because that barrier to entry is so incredibly low, you drop this diverse crowd into a 24-hour arena, and they immediately have to fragment into different survival strategies.
Based on what they can actually handle, right?
Yeah, based on their reality. The sources show the vast majority try to hide in the shallow end using demo accounts or micro-positioning.
Just testing the waters without instantly draining their savings?
Exactly. But then you have the adrenaline junkies, the highly active, short-term traders.
Oh, right. The ones basically trying to outrun the news cycle.
Yeah, they're reacting in real time to live inflation data or central bank shifts, and they use these specialized platforms like MT4 or CTrader.
Which are built for lightning-fast execution.
Right, and really complex charting. They need that speed because they're fighting for tiny, immediate margins.
Yeah.
But you compare that to the multi-asset veterans.
Who are playing a totally different game.
Completely different. Those players aren't staring at tick charts all day. They treat currencies as just one piece of a broader macroeconomic puzzle, hedging Forex against commodities or equities.
Wait, okay, here's where it gets really interesting for me. The sources also mention a rapidly growing segment of passive participants using copy trading or PM structures.
Ah, yes, PM structures.
Right, which act kind of like mutual funds, where investors pool their money behind a single lead trader. If a pro trader has spent 10 years figuring out this market, and I can just connect my account to auto-copy their trades, I mean, why wouldn't I just do that and go to the beach? Isn't that a risk-free cheat code?
It sounds like it, but the catch is that passive exposure is never actually risk-free.
Never, even with a pro.
Never. You aren't executing the manual trades yourself, sure, but you are completely tethered to that manager's psychological limits. You have to analyze their drawdown history.
Meaning how far their account typically drops before it recovers.
Exactly. And you need to understand their fundamental approach to risk. Because if their strategy blows up under pressure, the market doesn't care that you are just copying. It is still your actual cash vanishing.
And that ties directly into the trap of leverage, which the sources are incredibly clear about. This is how the 24-hour market exploits newcomers, right?
Oh, absolutely. High leverage is dangled out there so you can trade these huge positions with less capital.
But the math just works against you instantly.
Because brokers offer extreme leverage, you might only need to put up, say, $10 to control a $1,000 position.
Wow, just $10.
Yeah. But a mere 1% move in the wrong direction wipes out 100% of your actual cash. And the market is constantly hunting for that weakness, especially when institutional algorithms trigger during low liquidity periods.
So like revenge trading to win back a loss or swinging for the fences with max leverage is just a fast track to liquidation.
Exactly. Success isn't about predicting every market move. It's about downside protection. The ultimate irony here is that the constant availability of Forex is its greatest trap.
People think an open market means they need an open position.
Right. Retail traders fail because they overtrade.
Just because the casino is open doesn't mean you have to be at the table.
Precisely. The pros know that a huge percentage of trading is actually just waiting. Selective execution with strict position sizing consistently beats hyperactive trading. You have to understand the mechanics pulling the levers, like how a central bank altering its interest rates physically changes the flow of capital.
So what does this all mean for you? Forex is this globally accessible market that welcomes diverse starting points, but it absolutely rewards preparation over permission.
Surviving it isn't about having a funded account. It's about strict risk management and mastering your own emotional discipline.
Which brings up a final thought to mull over. We've established that traditional Forex is deeply tethered to national central bank policies and interest rates.
Very deeply, yeah.
But as we watch the continued rise of completely borderless, decentralized digital economies, how might that eventually force the Forex market to fundamentally change how it values money altogether?
I mean, the underlying definition of a currency shifts away from borders. That entire ecosystem will be forced to adapt.
Just something to keep in mind before you take that newly minted driver's permit out onto the financial autobahn.